Okay, give us your thinking.
In the short term, the concern about trade tensions will continue to weigh on investment sentiment. However, as we are now entering the quarterly reporting season, I believe the market will start to refocus on the fundamental driver and looking at recent price actions. In fact, investors, particularly the strategic and long-term investor, are now seeking for investment opportunities, especially for those market and sector which will stay relatively resilient from the U.S. Trade tariff. So looking at the China market, in fact, if we look at the northbound liquidity flow through the Stock Connect as well as the equity fund flow data, long-term investors are starting to add allocation to China equities in recent weeks on the back of the correction triggered by trade concern. And more importantly, we need to look at the key earnings driver in the China equity market as the Chinese economies are mainly driven by domestic sectors.
That rebalancing has happened in large part, hasn't it now, even though we do get trade numbers at the top of the hour, but I'm not going to really dwell on those. Mark Cudmore from MLive, our MLive blog, he was on earlier, and he's now become a China bull. He said the China bulls are slowly coming out of the woodwork. I suppose with prices like this and these valuations, if you're a long-term investor, it probably makes sense.
I think after all, equity investors are looking for growth, and in the China equity market, in fact, the MSCI China companies only derive 1% of total revenue from the U.S. market. Investors will start to ask about what exactly would be the fundamental impact of the trade tariff on companies' earnings. Currently, domestic demand contributes to more than 90% of China GDP growth.
So you agree with him? You should be a bit more bullish at long term.
I think that the best strategy to navigate the current market uncertainty is to stay invested and positions in asset class which will continue to do well despite the escalating trade tensions.
So where do you actually invest then? That's the point. For instance, we had Carlos Casanova from COFAS on a short while ago at the top of the hour, and they look at invoice lead times, how long people are taking to pay their bills, which gives you an idea that they may be financially distressed. And he was saying he was seeing the worst bits in the construction, energy and auto sectors.
Looking at the global equity market, we continue to favor the U.S. and Asian equity market because the U.S. and Asia are the two. When
you say Asia, do you mean China? Or
emerging Asia. Emerging Asia.
Okay,
and
so that includes China, yeah.
And China actually account for a substantial shares in the emerging Asia. And within Asia, we stay overweight China, India, and Singapore. China and India continue to deliver.
So you're not looking at any particular industry groups then?
For industry group, we particularly favor the consumer-facing and domestic-oriented sector because consumer demand will continue to drive resilient and robust earnings growth. And in China, we do believe the consumption upgrade, manufacturing transformation, and technological innovation will bring continued substantial growth, particularly with the technological disruption bringing new growth models and business driver. This is going to remain the key catalyst to support performance.
At the same time, we do